Hello everyone.
Hello everyone, welcome back to another video. Today we're going to be digging into cause and our interpretation of cause, also known as liquidity.
Yes, indeed. Jump over to the other screen. So yeah, cause is how we see the market. It's how we interpret the market. It's how we view the market. Cause and effect is what we see and what we try to identify on the screen. So essentially, cause is why it happens, and the effect is what happens as a result of the cause created. And that's essentially what we're going to cover today. So one of the first things before we jump into it in more detail is Burton's going to talk about the Wyckoff laws and how we interpret them.
Cool, so we wanted to go through Wyckoff's laws and how we interpret these laws in the market. So if you don't know who Wyckoff is, he's the quote-unquote godfather of the smart money concepts, where most of this originated from, if not all of this originated from. And so he has 3 laws. The first 1 and 3 we're going to go over in a future video, but we're just going to focus on the law of cause and effect today, and how we interpreted that as liquidity and how we understand cause and effect. So essentially, cause and effect can be anything from a momentum shift, so the cause of a momentum shift, and the effect is volume changing and so on and so on. The law of cause and effect for liquidity is liquidity being created and then taken, obviously for mitigations and for price direction. So I mean, going on to the market is liquidity, where Chucks is going to start talking about this one.
So yeah, market is the market is liquidity. Essentially, it's money moving. It's funds moving from one price to another, and that's what we're observing when we're essentially looking at these candlesticks or price delivery. So when we're looking at the charts and we're thinking about liquidity, it's, you know, there's no one specific thing that we're looking at. We're looking at everything and the cause that is being created to understand what the effect of that is, going to be. Now, you know, obviously we have our concepts that we use to identify this, but what we want to focus on here is essentially really, you know, focusing on that cause and the effect, and being in that mindset when we're looking at the charts.
The market always targets liquidity, and why does it do this? Because there's lots of transactions being made at these places. So think about liquidity at every single high, every single low. So this is where the support and resistance traders, the double top, double bottom traders are looking to get involved, or any people that trade at these highs and lows. These are essentially going to be them high activity places where lots of orders are going to be created, obviously giving cause for price to move into that zone to take that liquidity. Now we're going to show you what this looks like in the market, showing you 3 different examples so you can start to train your eyes. So first example, so first thing to note in here is the price delivery, which is quite important. Obviously we know this as range, initiation, mitigation, continuation, which is obviously creating that structure and showing us direction. So that's the first thing that we need to know. Second thing is how we look at liquidity. So a lot of you members that have been with us for a while will understand that we look at equal highs as liquidity, again for that high transaction area, which is up the top there, meaning liquidity. Second thing we look at is relative highs and lows, so something that will stop near the high but not actually hit the high, and essentially this is that whole area that we look at as liquidity, again being a high transaction area, meaning lots of liquidity is there. And then the third one is diagonal liquidity, where we have lots of stacked highs or lows together. Again, lots of transactions are being created at each high, meaning there's lots of liquidity stacked above here, and we draw a diagonal line there to show our liquidity.
Perfect.
So we want to take you through a few examples now of exactly what we've just described, and obviously the logic behind that. And me and Chucks are just going to go through this at the same time and just get as much out as we possibly can, just to give you more perspective on this. But essentially, if we're looking at price delivery, obviously, as I drew before, the bullish price delivery is exactly what we're looking at. And then what we're looking at on this chart is what cause is being built for higher or lower prices. And essentially, that's what then we start to mark up. Cool. So now we're going to look at what we just looked at before, bullish price delivery, which is essentially that range, initiation, mitigation, continuation, which is obviously what we're always following. But now we're going to look into liquidity and what cause is being created for higher and lower prices and why that's being created as well. So first thing we want to look at as well is these stacked highs. Obviously, this is liquidity being created for a future moment, as obviously we'll see that as resistance, or support and resistance traders would see that as resistance, or that double top, which is also what them sort of traders will see that as. So obviously that's cause for higher prices being created there. So again, a high activity zone that price is going to target, high activity liquidity zone that price is going to target. And also here, this is all stacked liquidity above here as well. Again, diagonal liquidity. And then we've got that relative equal highs here, which again would just be that box of liquidity. Again, all high activity areas. So if we're following that bullish price delivery, initiation, mitigation, continuation, it's about what's happening within that high to low of that mitigation.
And this is exactly where we're trying to train our eyes, is what's happening if, you know, even if you don't know where price is going to head or where it's going to react, the point is here is we're just using our understandings to follow the intentions of price. So, you know, if you didn't have, say, this area marked on for mitigation, right? Doesn't matter. Let's just focus on what price delivery is doing and what cause is being created and what is it trying to sustain. This is where we want to put our minds, because once you do know and you are able to identify these areas of mitigation, what you now have is the understanding that price delivery is delivering in a way to support the move that you're looking at. Again, this is what brings more information, more understanding, which is then breeds more confidence in what, you know, what we're looking at. So it's really important to really take these concepts, you know, on their own to fully understand them before you start putting them all together. But I think this is Burton's really gone through, picked a great example here to show, you know, obvious cause being created to support this mitigation for future higher prices.
Exactly. So I mean, this, even taking the understanding of our price delivery, where we know that range, initiation, mitigation, continuation. Now, once we understand that BFIs are initiating their positions to the upside, now we're looking at what's being created. So if there's lots of stacked lows created underneath here, you've got to ask yourself, why is lots of lows being stacked under there? And obviously that's to create a high activity transaction area so that they can mitigate out of their positions, potentially add on more, and then continue the price higher. And the liquidity that's stacked above here in that diagonal liquidity where there's lots of stacked highs or stacked lows, and that liquidity above here, again, it's just all transaction areas so that they can use that liquidity in order to run price higher.
That's exactly what you see happen. So when you're seeing price, like what Burton's drew here from this low to this high, like what we're seeing here is contained price delivery. Price is trading inside of this range. So what do we understand that's happening in this phase? Right? Cause is being created. BFIs are stacking orders before the move, right? Not after, before the move. And this is the cause that is being created. And the effect is higher prices. So mitigation here is supported cause to sustain that effect that's coming into the market, right? And that's where we see price move higher and obviously continue to move higher. So here's cause that right now we're looking at cause to support that mitigation and support that move away. And then once that move away has happened, obviously you see this liquidity is left here, you see this high likely to be run, you don't see any swing low break. So, you know, obviously this high becomes weak. So here's another form of, you know, liquidity that we're looking at. And essentially, when price is moving away, you see how price is doing the same exact thing again, right? Creating cause to support a future move. So when price is coming back up to this, you know, quote unquote, support area, resistance area, price is being contained once again, right? Before that initiation to take this high. So all the time we can follow what price is doing. The big key here is contained price action, right? Ranges are not just, you know, things we look at like, you know, like this in terms of initiation. Ranges are essentially made, you know, and created all the time in various different ways. But the understanding we have of ranges is what is the thing that you can take to every range that you're seeing. And that the understanding is that BFIs are stacking orders to initiate something in the future. And that's what we see here. Stacking, right? Creating that cause for something to happen in the future. Yeah, and here we can see that price is continuously creating cause or creating liquidity, right? To support an effect or a future move that's coming.
Exactly. I mean, I'm just drawing this on as an example. So even within this whole range that we have here, we also have another price delivery being that range, initiation, mitigation, obviously creating liquidity to mitigate out this position here and then to continue higher. And again, exactly the same is happening with this diagonal liquidity here, lots of stacked highs above here. Obviously, highs and lows are going to be those transaction areas, meaning liquidity, and then obviously price just runs that. So the cause is obviously to push down to mitigate out of this position. The effect is to take that liquidity and use in the same direction. I mean, I can even show you on here as well, this example here left is another range, initiation, mitigate out the position, but create more cause for lower prices, which is essentially this here. And then push back up into that zone to mitigate out of positions again, and then obviously to take that liquidity. It's the same things happening over and over again. This is just the understanding of direction and is that essentially exactly the why things are happening. Why is liquidity being created here? Why is liquidity being created here? Why is liquidity being created here? And then finding out the answer, because all of this here is just cause for higher prices. That's all it's doing. It's just creating more transaction areas.
All we're looking at is essentially the market moving up, the market pulling back, and the market continuing, right? Don't let there's no noise on the 1 minute that people talk about. We're seeing that same higher time frame price delivery, but we're seeing it in more detail to support our understanding, our confidence, and our ability and our skill to trade from a very confident place. This was one last thing I was going to say, which has left my mind. That's the last thing is so notice that if you're in this trade, take that back off. If you're in this trade, right, or you're in maybe a previous long position or a long position from here, we don't just hope. We don't get into a trade and hope that we're going to see higher prices, right? While you're in the trade, follow the cause. And here's another thing, right? Cause is going to be created before we see a push above or below a high or low, right? So when you're in this trade, don't be afraid here, right? In terms of, I'm not sure, I might take profit, or, I might move my stock to break even. The understanding that we're trying to pass on here is that we expect to see this type of price delivery before we get something that looks like this. Right? Sorry, other way around. Before we get something that looks like this, right? That push and that break of that high, right? And it's very simple, as we see: move up, pull back, continuation. But to support this continuation of higher prices, we've created cause again, and then we've moved, right? So you can think of these areas more as places to get back in, or if you haven't got into this move but you're following that delivery, to then obviously try and catch that continuation move before this high is taken. Because once this high has been created and we see that prices, following that sustained mitigation and making higher prices, any trades within here, a very high probability. Essentially, you're following that initiation of what's just been created down here, and knowing that price is going to want to target this level. So I guess that explains it.
We're going to say as well, in addition to that, the reason that we call it cause is because cause is being created to obviously what we said before as well. The market always targets liquidity, so that means that it's caused to run higher or caused to move lower. So if liquidity is being created at the lows, that's why we call it cause. It's caused to move lower because price is going to want to target that low or those stack of lows or that stack of liquidity and then mitigate. and then price is now going to want to target this liquidity, because if we see this as a strong low, we know that this low is not going to be taken. So now where's the next liquidity that the market can target? Here, here, and here, and then obviously eventually this high here, and then that's exactly what happens. And then along the way, it's going to create more weak highs, more weak highs, more weak highs, more weak highs, and so on to obviously take that. And then when there's not enough liquidity left there, or it needs to create more liquidity, then it will just create ranges, create more liquidity above here, more liquidity above here, and then obviously to run. And that's exactly what it's going to do. It's just going to try and get as many people involved in the market as possible, as it possibly can, and then obviously just run that liquidity and use it. But just again, it's more narrative on top of why we're using Caue.
The BFIs are using this liquidity to initiate their orders, right? So when there's players in the market initiating their positions, and that's essentially the liquidity that's been added to the market that the BFIs are looking to use to initiate their positions. Essentially, they're trying to disguise what they're doing. They don't want you to know that they've initiated orders, and this is why they do it in a range. And this is why, obviously, as you know, from a retail perspective, ranges, you're taught to stay away from them, and you don't want to know about them. But actually, it's the opposite. You want to know about ranges because this is the identification of what's about to happen in the future. Yeah. On to the next one.
So that's first example. I'm going to take you through 3, so they're all going to be slightly different in their own way.
Yeah, so this is the one I wanted to go over, and I want to talk about this one from a more of a full picture perspective, rather than diving into too much detail. But please, guys, again, even though we show these, we have these videos, we have these talking points, we're not going to mention absolutely everything. So, do look for yourself and build your understanding and train your eyes to what we're seeing. But yeah, this one again from a more broad perspective. So yeah, we see mitigation continue up, right? We need to ask ourselves, first of all, that when we've had this mitigation here and we have that run of higher prices, what have we left behind? Right, so that's I'm not going to say much more than that. Obviously, you guys know. And then we see higher prices come into the market. We break the high. So again, we know that there's going to be cause created before we see intentions or sustained intentions. Right. So what I'm saying there is we're going to see cause created before we see that next swing move. So this is what we're anticipating. So as you see, price runs up and moves into this delivery here. So we have a high, we have a low, we have contained price action within this range. So, what does this look like? We have equal lows below, we have stacked liquidity inside this range, and look how price is delivering away, exactly, Burton's drawing it on, right? And then we get this higher move. So you can see how we're getting this continuation of this cause and effect, cause and effect, cause and effect, right? So we can see this is always coming into the market, exactly. Look how this high gets run, right? This is showing you that this is them targeting this liquidity and taking that liquidity. So yeah, just to talk about this price action in a bit more detail from this point forward. So we get this run of higher prices, we get this move back into this range for this mitigation. And again, what I'm trying to show you here is how price is moving through this whole price delivery, right? In between these session times, as we can see, price is, breaking these highs and then pulling back into the range, breaking the highs and pulling back into the range. So this intention of higher prices, right, in terms of us seeing higher prices, we see that in this price delivery, we're not getting, that real run of price. And what stands out to me here is that the way price is delivering, essentially, we're seeing all this liquidity being left behind. So where you have this equal low and we have this, stacking of sideways price delivery that's creating this liquidity void in here. So here's the kind of key thing that I want to kind of use this price delivery and show. So we have this tap of something left, right? And we see this run down into exactly as Burton showing you, into this previous place that we mitigated and ran higher. So notice how this void down here, right? I say void, but just think of it as liquidity. This liquidity void down here gets completely run, right? And we see no swing higher. So now we have equal lows, we have this stack of liquidity. In my mind, I don't really need to know much more than that in terms of what price is likely to want to target, especially when we're moving into New York session. We've just moved above this high. We can quite clearly see we've had that rejection, right? We've created liquidity to support a future move, and that's what we see happen, right? So a lot of people may be looking at this as a mitigation.
Sorry.
That's right. A mitigation for higher prices. But what do we know? We know that if this is a real momentum shift, a higher time frame, 1 minute, so is a real 1 minute momentum shift from a higher time frame point of interest, or a previous range, we know that we don't want to look at this, right? Because this just comes liquidity to support a run. So I'm not looking to try and, only because we've had this continued up move, based on how price is delivering, I'm not looking to get into a long trade here, right? Obviously, how price is moving down, this might have obviously thrown you off, but, for me, I'm not, or for us, should I say, we're not looking to take anything underneath all of this liquidity in terms of trying to play a mitigation to go long. So as you can see, before this has even happened, we have a good idea on what's possible to come in the future, because of how price has created, how this price delivery has created this cause, and then what that effect could look like. So when I'm seeing this price delivery, trying to get into any shorts from this perspective, that's what I'm aiming to do essentially. I'm trying to catch that move before the move. And this is how we are using this cause and effect concept and this understanding to build more narrative, right? We're not looking to take this because we understand this is cause to support a run of lower prices. It's as simple as that, really. And again, the picture we're looking at here is that sorry, let's clear my charts. The picture we're looking at here is that clean intention of higher prices, right? But it's created in a very sideways delivery for then that run of this equal lows into something down here, right? And that's where we talk about structure and timeframes. So yeah, I think that was, hopefully that's pretty clear. But again, just trying to zoom out and gain that, we don't always have to be, very zoomed into the chart. We can zoom out of the chart and still use our same concepts to build the idea of what we can expect to see and to be supported in the future. Yes, sir. Thanks for marking it up, Burton.
Sorry, I was trying not to throw you off while I had an idea of cause and effect and how we can use that as you're describing it.
Yeah, no, it's perfect. It's perfect. Perfect. I think I'll be able to see. Yes.
Cool. So that brings us on to our third example now, where we're again looking at price delivery, range, initiation, mitigation, continuation higher. And obviously we're seeing again that range, initiation, mitigation, continue higher, obviously creating that structure for us, that bullish structure. So now we're just going to dig into the liquidity side of things. So obviously once we've taken out all the liquidity from this high, then we're looking at what liquidity is being created. And essentially we've got a bearish price delivery here, creating lower prices. But why has that created lower prices? Again, it's to create future liquidity, which is stacked above this high, and obviously created liquidity underneath here, which was then taken again. This is all to create future liquidity up here, and also to create liquidity to move back down to mitigate out of their orders from this sell to buy within there. So obviously that liquidity is created at the top there. We've also got this mitigation. So this mitigated the open of this OB here, this FU, which is sell to buy. But as you see, we didn't continue higher from this. So when we get a mitigation but we don't continue higher, either that's you're on the wrong side of the market, or that's just going to create more liquidity. So again, above every high, there's liquidity. This is just stacking more and more liquidity now to obviously run, and we see that as diagonal liquidity. Lots of highs stacked together.
Can I quickly jump in?
Yeah.
So, and it's good price delivery here, because you know, there's many trades I've placed where I would be in this trade and it would run, and then it would just mitigate something up here, and then it looks like it's just going to drop out, you know, it's going to, you know, go to death essentially. But what is it, as Burton, what it's doing is creating that cause for that move. Because if you notice, when we had this mitigation, we don't have no cause for higher prices. So it's a clean example of, you know, this is rather going to do this, right? Or it's going to move up and create cause for that sustained move. So if you did get into this trade and you do see that reaction, and then you see that cause starting to be created, you kind of know that cool, price is probably coming to mitigate something in here or run lower to then obviously take this at a future price. But I think it's just good here seeing this example of this mitigation versus this mitigation, right? One has cause to support a sustained move, and one doesn't. Yeah, back to you.
Cool. So also I was going to say about, so that's within the price delivery that we've just spoken about here. So now outside of that price delivery, we have to look at what cause is being created for either higher or lower prices. So obviously cause is created as soon as we mitigated here for lower prices. Obviously we see them equal lows being created there. And so imagine that we're in this position here, and imagine we've taken this trade here as an example of 50% of this OB here. Now we're seeing price momentum shift here, seeing that momentum shift into higher prices. And now what we're doing is we're following price. So again, we're watching what cause is being created. So cause is being created here for lower prices, and cause is being created here for higher prices, obviously to mitigate out of something within this wick here, which will be second time frame. But again, this is what we continuously do. So now we're watching as liquidity is being created and moved higher. So as we're seeing this liquidity being created across all these lows here, but prices moves higher, we know that this is future liquidity. This is future liquidity. This is future liquidity. We look further back and we see all these stacked lows together. This is future liquidity. So now this is starting to build a narrative of what could happen next, and obviously taking into account the session times as well, which is another thing to take into account. But this is just giving us narrative. This is giving us understanding of what can come next. And obviously we see all that liquidity just get run. All of this liquidity get run on the right here. And Chuck's wanted to talk about this down here.
Yes. Now. So we've just gone over this whole picture. Do you mind deleting your, yeah, cheers. So yeah, just run through all of that. Again, as I explained on that previous example, you know, we're likely, and again, I could jump into this, you know, price delivery here, but this, you know, you guys can do that. You know, this is what you should be doing in your markups. You should be aware anyway. But yes, you know, perhaps we have mitigated something left, and then we see that initiation coming to the market. So when we see this type of reaction, right, it's definitely something that stands out to me, and you know, even just this price delivery in itself. But when we're seeing this be that effect of this mitigation, straight away I'm thinking about the cause. Like already I'm thinking about, I've already had, as Burton just went through, that cause and that narrative, the logic or the understanding in my mind. So there's not much else that I'm thinking, right? My understanding now is that the intention from how I'm looking at price delivery is that it's coming to run lows, right? It's coming to run lows, and what I expect to see is a sustained move or the cause created to support a move lower. So that's obviously what we have. We see that previous to this mitigation, we have cause created, and we continue from that mitigation, and we again look how price is moving away. We know that with the strong highs, how do we know we have a strong highs? Because price will continue to create lower highs, moving away, right? Sustaining that push. So then we have this last range before that big drop. And now we have to ask ourselves, right? We've got this liquidity here, and we've got this liquidity here. this equal lows, essentially what it's done is it's moved into the liquidity that was sat within this range, this move down, right? And it's been contained and left all of this liquidity, right? This cause for a run. And look what happens in this exact area. Look how price is moving through this low, right? It's a very unique price delivery that you will see, that when we get these types of candles, right, where you can, or series of candles where we're getting the market completely drop, typically it's to take out something, right? And the reason why price is moving like this is because there is no buy side liquidity that is in their way, right? They've run the whole range of all this liquidity, and now this is where they initiate their last positions for that in this range. And as we know with law and effect, cause and effect, we see that this cause of this mitigation has the effect to run these lows, supporting these lower prices. So the thing I just want to point out here, just in case you missed it, is how price creates this void in price, right? Notice how this is, you can see it's been created on purpose, and then how price is actually running through that void and that type of price delivery. So just something to look out for. And for me, as I was just saying to Burton, and when we was talking through this video, is what I've noticed, and again, this is just for me, I'm not saying that you guys should go out and do this, right? I am able to catch, by knowing this information that we're sharing with you now in terms of how the cause is being created, I know that I can catch any moves that are super close to this void, right? In terms of it taking, I can catch any moves, any short moves close to this low, because from my understanding, I know that the intention of price delivery right now is to take out this low, right? Because it's super close. So then I can, if I've missed any moves from up here, right, or I've just come onto my chart, then I will be looking to get into this move, to follow this continuation just for this run of price. But yes, just to
add on, that just shows the importance of looking at the market in a cause and effect way, and that's how we really leveled up with looking at liquidity and kind of interpret it in the way that we do, because understanding that price is going to target this liquidity, and all this liquidity down here is being created for lower prices, then gives you confidence to take any positions in this way down after this momentum shift, because you know where the price is going to be targeting. It's going to be targeting all this liquidity. Yeah, that was it, just for that one. So.
Exactly. And it's, you might be thinking at this stage, when price is in, essentially discount, that you don't want to take any positions, but just think to yourself, are you following mitigations? And it's important when we start following mitigations after this momentum shift, right? Obviously, we know that price moves up into here, reacts. So, we have this, unmitigated area up here, but that's perfectly fine. We obviously move off of any fills or inefficiencies, but when we start to follow intention of price, right, we get this one here, this range, initiation, sweep of a low, right, back in mitigation, and that continuation. So if you're looking here at this time, of course you don't have to play the trade. You might have said you've missed it, but for me, what I've noticed is that me missing it is only what I'm telling myself in my head. I'm asking myself is, how can I still get involved in this price delivery? And with this, again, this understanding, I'm able to, force my way in, but I'm forcing my way in with a narrative of understanding that likely this is not going to get run until we see lower prices, because that's what the cause has been created. So yeah, don't if you're sitting here thinking, oh, I'm going to wait for price to get up here to take my trade, right? If I was wrong in my thinking, then this, any trades within this price delivery here would not work out. But as we see, it does work out, right? Because we do get that sustained move lower. So yeah, this is how we're bringing confidence to my entry, how I'm bringing confidence to my entries, through understanding of, cause and effect and what's likely to happen based on the cause that has been created.
Cool. So thank you all for watching. Obviously, we've taken you through the understanding of these 3 pictures here and kind of dived in a lot deeper into our understanding and our interpretation of liquidity and why we call it cause and what cause and effects mean to us. So obviously let us know what you think about this video and what you took away from it. And again, thank you for listening.
Thank you.